Hey, what's up everybody? It's Cobra Trader. Join me as I dive into the world of trading and try out some unbelievable tips from Quotex. Today, we're going to talk about some trading tips that can change the way you approach trading. These tips are so powerful, they'll make you wonder how you ever traded without them. So, whether you're a seasoned trader or just starting out, grab your notebooks. Let's get started. This first tip is all about taking a step back from the charts and looking at the bigger picture. It's easy to get caught up in the excitement of a potential trade, especially when you see everyone else jumping in. But remember, the fundamentals are the backbone of any good investment decision. Now, what do I mean by fundamentals? I'm talking about the underlying factors that drive the market. Think of it like this. If you're buying a house, you wouldn't just look at the paint color and call it a day, right? You'd want to know about the foundation, the roof, the neighborhood. You dig deep to make sure it's a solid investment. The same goes for trading. Before you hit that buy or sell button, you need to understand what's driving the price of that asset. Is it a strong company with solid earnings? Is it a commodity with increasing demand? Or is it pure speculation and hype? Analyzing fundamentals takes time and effort. It's not as glamorous as chasing the latest hot stock tip you heard about on Twitter, but trust me, it's worth it. By focusing on the fundamentals, you're making informed decisions based on logic and reason, not emotion and speculation. Think about it like building a house. Would you rather build your house on a foundation of sand, where it could collapse at any moment, or would you rather build it on a foundation of solid rock, where it can weather any storm? Fundamentals are your rock. Start by understanding the basics of the market you're trading in. Read industry reports, follow financial news, and learn how to analyze a company's financial statements. Remember, trading without understanding the fundamentals is like driving with your eyes closed. So, take the time to learn the fundamentals, build a strong foundation for your trades, and set yourself up for long-term success. Alright, let's talk about risk management, the not-so-glamorous but absolutely crucial aspect of trading that can make or break your success. Now I know what you're thinking, risk management? That's boring. Let's talk about making it rain with those sweet, sweet gains. And listen, I hear you. We're all here to make money, right? But here's the thing. You can't make money if you're constantly blowing up your account. It's like trying to fill a bathtub with the drain wide open. It's just not going to happen. Risk management is all about protecting your hard-earned money. It's about making sure that even if a trade goes against you, and trust me, it will happen, you're not wiping out your entire account. Remember, in trading, we want to live to fight another day. So how do you actually manage risk? Well, the first step is to understand your risk tolerance. How much are you comfortable losing on any given trade? This is a personal decision and there's no right or wrong answer. But it's important to be honest with yourself about your risk appetite. Once you know your risk tolerance, you can start implementing risk management strategies. One of the most important tools in your arsenal is the stop-loss order. A stop-loss is like an insurance policy for your trades. It automatically sells your position when the price drops to a certain level, limiting your potential losses. Think of it like this. You're buying a stock at $100 per share and you're only comfortable losing $5 per share. You would set your stop-loss order at $95, so if the stock drops below that price, your position is automatically sold and you're out of the trade. No emotional attachment, no second guessing, just pure risk management. Another key aspect of risk management is position sizing. This refers to the amount of capital you allocate to each individual trade. A good rule of thumb is to never risk more than 1 to 2% of your total account balance on any single trade. By managing your risk and protecting your capital, you're setting yourself up for consistent long-term growth. Remember, trading is a marathon, not a sprint. Manage your risk like a pro, protect your capital, and watch your trading profits grow steadily over time. Tip 3. Be selective. Now let's talk about being selective with your trades. In the world of trading, less is often more. You don't need to be placing trades every single day to be successful. In fact, sometimes the best trades are the ones you don't make. Think of it like being a sniper, patiently waiting for the perfect shot. You wouldn't just start firing randomly, hoping to hit something, right? You'd carefully choose your target, wait for the optimal conditions, and then take your shot with precision and accuracy. The same principle applies to trading. Don't just jump into any trade that looks remotely interesting. Be patient, wait for the right opportunities, and then strike when the odds are in your favor. Remember, you don't need to swing at every pitch to hit a home run. So, how do you become a more selective trader? It starts with having a clear trading plan. What are your goals? What are your risk tolerances? What type of trading strategies are you most comfortable with? Once you have a solid plan in place, you can start identifying trading opportunities that align with your specific criteria. Don't be afraid to say no to trades that don't meet your standards. It's easy to get caught up in the fear of missing out, especially when you see others making money. But remember, every trader has their own unique style and risk tolerance. What works for one person may not work for another. By being selective with your trades, you're increasing your chances of success and setting yourself up for long-term profitability. Tip 4. Adapt to changing market conditions. The markets are constantly changing. What worked yesterday might not work tomorrow. To thrive as a trader, you need to be adaptable, like a chameleon blending into its surroundings. Think of the market as the ocean. Sometimes it's calm and predictable, with gentle waves lapping at the shore. Other times it's a raging storm, with towering waves crashing down with unpredictable fury. As a trader, you need to be able to navigate both extremes. One of the biggest mistakes traders make is becoming too attached to their strategies. They find something that works, and they stick with it, even when the market conditions change. But just like you wouldn't wear a swimsuit in a blizzard, you shouldn't use the same trading strategy in every market environment. To adapt to changing market conditions, you need to stay informed. Keep an eye on economic news, political events, and industry trends. These factors can all impact the markets in unexpected ways. Pay attention to market sentiment. Are investors feeling bullish or bearish? Is there a lot of fear or greed in the market? Understanding market sentiment can give you valuable insights into potential market movements. Don't be afraid to adjust your trading strategy as needed. If the market is volatile and unpredictable, you might need to tighten your stop-loss orders or reduce your position size. If the market is trending strongly in one direction, you might want to consider riding the trend. Embrace the challenge of adapting to changing market conditions, and you'll be well on your way to becoming a more successful and resilient trader. Tip 5. Trade against the crowd. Alright, are you ready for a game changer? This final tip is not for the faint of heart. It takes courage, conviction, and a healthy dose of contrarian thinking. It's about going against the grain, challenging conventional wisdom, and yes, trading against the crowd. Now I know what you're thinking. Are you crazy? Everyone knows you're supposed to follow the herd. And listen, I get it. There's a certain comfort in being part of the majority. It feels safe, familiar, and less risky. But here's the thing. The crowd is often wrong, especially in the markets. When everyone is euphoric and buying with reckless abandon, that's usually when the market is about to top. And when everyone is panicking and selling everything they own, that's usually when the market is about to bottom. Think about it like this. When a stock is featured on the cover of a major financial magazine as the next big thing, it usually means that the price has already gone up significantly and the smart money is already cashing out. The crowd is late to the party. Trading against the crowd is all about identifying these moments of mass hysteria and taking the opposite side of the trade. It's about being a contrarian, a wolf who's not afraid to stray from the pack. Now, I'm not saying it's easy. Trading against the crowd can be lonely, nerve-wracking, and downright terrifying at times. You'll have moments of doubt, wondering if you're the crazy one. But if you can learn to master your emotions, trust your analysis, and tune out the noise, the rewards can be substantial. One of the best ways to identify opportunities to trade against the crowd is to look for extreme sentiment readings. When everyone is overly bullish or bearish, it often signals a potential reversal is on the horizon. If you can master this skill, you'll not only be a better trader, but you'll also develop a valuable life skill. The ability to think critically and independently, even when it's uncomfortable. So there you have it, folks. 5 unbelievable Quotex trading tips that can completely change your trading game. Remember, trading is a journey, not a destination. It's about constantly learning, adapting, and refining your skills. Which tip surprised you the most? Let me know in the comments below. And if you want to learn more about trading strategies and tips, be sure to check out my other videos. Until next time, happy trading.